Hello and welcome to another episode of Portfolio Perspectives with me, Tom Santa-Olalla. When volatility and uncertainty hit markets, investors often find themselves asking a very natural question: where are the safe havens? But the word safe can be misleading. When it comes to investing, a safe haven asset isn't necessarily a risk-free asset, but one that diversifies your risk for when portfolios come under pressure. In previous videos, we introduced the concept of market regimes and how they impact portfolio construction decision-making. So today, rather than asking what is safe, we're asking what role do different assets play within a portfolio to provide diversification of risk? But also, what are the opportunities provided to us in today's environment? And to unpick all of that, I'm joined by one of our analysts on the multi-asset team, Valencia Agera. Valencia, welcome.
Thank you, Tom. Great to be here.
Let's start with that phrase, safe haven assets. What do we actually mean by it?
In simple terms, a safe haven asset is something investors hope will provide some resilience when markets become unsettled. Traditionally, it might be something like a high-quality government bond, or gold, or even some assets held within our alternatives portfolio. But the key point, as you've alluded to, is that safe haven is not a permanent label. Rather, it's a role an asset plays within a portfolio at a given moment in time. And that role depends on the type of risk you're trying to manage or the current investment regime we're in.
And what do we mean by that?
Let's take a few examples. If the concern is a sharp slowdown in economic growth, then historically high-quality government bonds have increased in value. However, if the concern is inflation, geopolitical disruption, or fiscal pressure, which has most often been the concern in the current regime, then gold can be a good diversifier. And if the worry is liquidity, then cash can be valuable. So investors shouldn't look for a perfect hiding place in portfolios from volatility. Our job is to build diversified multi-asset portfolios that are resilient in multiple different scenarios and are tilted in accordance with the current regime.
And in previous videos, we've introduced this current regime as global fragmentation. How is that impacting our decision-making?
In the post-pandemic world, we've seen supply chains being brought back on shore with isolationism and protectionism displacing collaboration, and the geopolitical rules-based order of decades gone by has started to break down.
And so in this environment, we'd expect to see higher government spending, potentially higher volatility, and higher average inflation over the time frame, which would possibly lead to different asset classes interacting with one another slightly differently to how they might have done in regimes gone by.
Exactly, and actually we've seen this pattern of behaviour since the beginning of the regime in 2022.
So let's bring it back to today's situation. So volatility struck with the outbreak of conflict in the Middle East. But some of the more traditional defensive assets haven't necessarily acted as one might have expected. Why is that?
So the first thing to say is that so far the market reaction across asset classes, other than commodity prices, has been reasonably contained. Equities at the worst point on the 1st of April fell about 10% from its peak. But actually, as a diplomatic resolution became more probable, they quickly recovered back to all-time highs. Stepping back, generally we've seen a pattern in this regime where, because shocks have been predominantly of an inflationary nature, the market has been increasingly concerned about rising interest rates. Therefore, bonds, for example, as a diversifier, haven't been as impactful as they were in a previous regime. So in some ways, you could argue that traditional safe haven assets haven't really had a chance to shine.
And the dollar often sees a flight to safety in this type of environment, but we haven't seen much of that, as one might expect, potentially linked to the White House policy around its currency management. Is that a consideration?
Yes, and that's been a key consideration in managing our currency exposure. But ultimately, although conflict in the Middle East is a real risk, actually the underlying fundamentals of the broader macroeconomy are still very healthy. Trade has been resilient, company earnings continue to grow, consumers are spending, and we've seen a huge amount of investment in artificial intelligence. And we think this is a key reason why the markets have continued to rise.
So it sounds like the aim is to be nimble but without overreacting to market news.
Exactly, and it's crucial not to get whipsawed by the market with knee-jerk reactions. There's a huge amount of political hyperbole and attention-grabbing headlines, but we must ground our decision-making in tangible indicators.
And what are those exactly?
These are measurable, real-world signals that provide evidence of economic or business activity, helping us focus on what's actually going on beyond just market or political noise. So taking the Middle East, for example, that's looking at the amount of tankers actually getting through the Strait of Hormuz, or if the ceasefires are being adhered to. And all of this needs to be incorporated into our fundamental macro and micro analysis.
And over the course of the year, we've been trading in some of the more sort of traditionally defensive asset classes, gold, government bonds. What is our thinking there?
Starting with gold, we've held gold in portfolios for a long time. At the beginning of 2026, after a fantastic run last year, up over 50%, we decided to reduce our positions in gold when prices were around the $5,000 per ounce mark. And this allowed us to lock in some significant profits and reappraise the investment thesis. We do, however, continue to hold a strategic long-term allocation to gold within portfolios.
And what about the government bond side of things?
We had held low allocations to gilts, but when the yield on the UK 10-year gilt moved through 5% in March this year, the first time this has happened since July 2008, we decided to increase our exposure at a more compelling price.
So it sounds like even the defensive assets within a portfolio need careful, active management.
Absolutely, and risk management is not just about what you own, it's about how much, what price you paid, and the role it's intended to play. A diversifying asset can become a real source of risk if not managed correctly. And of course, we continue to manage the equity exposure of our portfolios as the global situation evolves.
You mentioned equities in there, clearly not a safe haven asset, but there are aspects of it that might be considered more defensive than others. Has the current environment provided any opportunities?
So, as part of global fragmentation, we've also introduced a new theme, security, to our process, and stocks within it have performed relatively well. Where appropriate and depending on ethical restrictions, we have been investing in defence companies which have performed well. We have also been investing in global mining companies such as Rio Tinto and BHP, which have significant exposure to iron ore and copper. Stepping back, as part of the security of resources theme, we see a structural opportunity in commodities, especially as they play a key role in the global transition towards renewable energy and electrification. In other parts of the portfolio, we have also reintroduced exposure to the broader energy sector, where ethical restrictions have permitted. But in reality, there are lots of areas of the portfolio that continue to perform well. And while geopolitical tensions dominate the news, portfolios are still influenced by a myriad of factors that we continue to monitor.
So when it comes to safe haven assets, it sounds like there's no get out of jail free card. It's about being nimble without being overly active, but also maintaining that diversification of asset classes within the portfolio. Valencia, that's been really helpful. Thank you so much.
Pleasure, thank you.
And thank you for watching. If you'd like to hear more about how we're positioning your portfolio within the prevailing environment, please contact your investment manager. And do look out for our latest on the macroeconomic side of things from Guy Munson's 6-Minute Strategy. Thank you.